Wealth building is often misunderstood. People think it is luck or timing, a perfect moment, a perfect opportunity, a sudden breakthrough. But real wealth does not work like that. It comes from structure and strategy. Over time, not a single decision, but a series of decisions, repeated consistently. Investing is not random. It is a system, a structured process designed to grow capital step by step. Smart investors do not chase trends. They do not follow hype. They do not react to every market movement. Instead, they focus on fundamentals: value, stability, long-term growth. Because short-term noise creates confusion, but long-term structure creates clarity. The first principle is allocation. Money is divided intentionally, not randomly, not emotionally, but strategically. Some goes into stocks, it's some into real estate, some into safer assets. This balance reduces risk, because no single outcome can destroy the system. When one asset slows, another may grow. This creates stability, and stability is what allows growth to continue, even during uncertainty. The second principle is consistency, investing regularly, not just when things look good, not just when markets rise, but consistently, month after month, year after year. This removes emotion from decision-making. You stop guessing, you stop timing, and you start building. Small investments may seem insignificant, almost invisible in the beginning, but repetition changes everything, because consistency turns small actions into powerful outcomes. The third principle is reinvestment. This is where most people fail. They earn returns and spend them. But smart investors do something different. They recycle returns back into the system. This accelerates growth because now your money is working on itself. Returns generate returns, and those returns generate more returns. This is where compounding begins. At first, it feels slow, almost like nothing is happening. But over time, something changes. Growth starts increasing, not in a straight line, but exponentially. This is the moment where the system starts working for you, not because of effort, but because of structure. The fourth principle is patience. This is the hardest part because everything today moves fast. People want results quickly, instant success, instant returns. But wealth does not follow speed. It follows time, slow decisions, consistent actions, long-term thinking. This is where most people fail. They start strong, they invest, they build momentum, but then they stop. Or it's too early before compounding works. Before systems mature, before results become visible, they exit the process, just before it begins to reward them. The fifth principle is risk management. Because growth alone is not enough, protection matters. Preserving capital is just as important as growing it. Smart investors avoid unnecessary risks. Do not gamble, they do not overexpose, they diversify across assets, across sectors, across strategies. This reduces volatility, because no single mistake can destroy everything. This creates control. Control creates confidence. Another key factor is behavior. Because wealth is not just financial, it is psychological. Fear causes people to sell early. Greed causes people to take risks. Emotion breaks systems, but structure removes emotion. It replaces reaction with discipline, and discipline creates consistency. Over time, this consistency becomes identity. You stop guessing, you stop reacting, you simply follow the system. And that is where real wealth is built, not from big wins, but from repeated actions. Day after day, year after year. Another important idea is time in the market, not timing the market, because predicting short-term movements is unreliable. But participating over long periods is powerful. Time allows compounding. Time allows recovery. Time allows growth. Without time, even the best strategy fails. With time, even simple strategies win. This is why wealth is not complex, but it is difficult. Not because it is hard to understand, because it is hard to follow consistently. Most people know what to do, but few actually do it, and even fewer continue doing it for years. That is the difference. Not knowledge, not opportunity, but execution. Three key insights emerge. First, wealth comes from structured investing. Second, consistency is more powerful than timing. Third, compounding creates exponential growth over time. The system works, not instantly, not dramatically, but reliably. And reliability is what creates real wealth. The question is not whether it works. The question is whether you will follow it. Stay consistent. Stay disciplined. Stay patient. Long enough to see the results. If you want more insights into investing systems, wealth building, and financial growth, explore more videos on Wealth Finance 61. Like the video, subscribe, and share your thoughts below. Because wealth is not created in moments. It is built over time,